In this presentation, we will enter a sales receipt. In other words, in the past, we've entered an invoice and then the receipt of the payment. This time, we're going to have the sales receipt, which means we're going to have the sale happening at the same point in time the payment is received. Time to engage with Sage 50 Cloud Accounting. Here we are in our Get Great Guitars file. We're currently in the customer and sales section. We're going to be looking down here in our flowchart. Last time we had been entering invoices and then receiving the payment on them. This time we're going to imagine the situation where we're just going to receive the payment at the same time we do the work. We might imagine like being in a store. If we're in the store, like our guitar shop, this is going to be like our guitar shop. If we're in the guitar shop, we have the cash register up top. Someone comes up and just brings something to the front of the shop. We purchase it at that point in time. Then we're going to receive the payment at that point in time. We're going to use the same form, but we're going to use it in a little bit different way. In other words, we used it last time when we had the invoice and then the receive money. We're still going to use the receive money, but we're going to use it in a bit different way as we format this. Let's first take a look at our financial statements because we will be making a form. We want to think about what the effect on the financials will be. So we're going to go to the reports and forms. We're going to go to the financial statements. We're going to be taking a look at that balance sheet. So let's open up that balance sheet so we can do so, can take a look at it. We're going to go to the current range, or let's go to January. We want to check it out in January. Take a look at it in January. So there it is, and then we're going to go to the income statement. Let's do the same thing for the income statement, the P&L, the profit and loss. So we'll pick up the income statement. Let's pick up this one. This is the one I like to see. So we'll pick up the income statement. We'll make that for January. So that's going to be January as well. And so that's what we have thus far. So now, actually, it's not in January. Hold on a second. Well, I'm going to change the range here. I'm going to make this for the range of January, like so, and like so. So there we go. And then I don't need, let's actually pull out the zero balances this time, and that'll make it easier to see. And then I'm going to say okay. So there's our income statement. So what's going to happen now? Well, it's going to be looking a lot. This will be very similar to an invoice. What's going to happen when we do the sales receipt? So what accounts will be affected? Major difference between this and the invoice is that instead of accounts receivable going up, as does with the invoice, we will instead have cash go up, either the checking account or the cash on hand, depending on if we're going to put it directly into the checking account, or more likely with this case, we're going to need some kind of method like a cash on hand if we're thinking about a situation where we have a check register, because we're going to have to combine that check register money together and put it into the bank, which might mean actually physically going to the bank and putting it in the bank in some kind of lump sum. And that's how it will show up on the financials. So we want to make sure that we group it in some way that we can then see how it's going to show up on the financials. So we might then go through this cash account then, and then put it into the checking account. So that's the method that we will use. The other side, go into the income statement then. So the other side, go into the income statement. It's going to be going to the sales. I missed the income statement. It's over here. There's the income statement. It's going to be going into the sales, just like this is just like the invoice, except the sales are going to go up, not including the sales tax, just including the sales price. The cash is going to go up by the amount plus the sales tax, of course. The difference then being in the payable account. So just like with the invoice, the payable account then, if we go back on over the balance sheet, is going to be going up, the sales tax payable. Then if we sell inventory, the inventory will be going down, just like as an invoice, not by something that will be on the sales receipt, but the sales receipt driving that decrease. And then the other side of that will, of course, be on the cost of goods sold, on the P&L, profit and loss for the cost of goods sold. Now let's record it and see if that is indeed what happens. I'm pretty sure it will be. I'm pretty confident. So we're going to go back over here. We're in the customers and sales. We're in our flow chart down here. We're now kind of cutting off this side. We're not having an invoice anymore. We're going directly to the receive money, which is basically a sales receipt type of form, the way we're using it here. So receive money from customer. So we're going to say receive money from customer. I'm going to make this large. I'm going to put an ID ticket. And then I'm going to say the customer is going to be string music, which I think is new. This is the new. So we have a new customer. So I'm just going to go down here and say we got a new customer. So we're imagining new customer as walking into our guitar shop and coming up to the top of the register here with a guitar. And we're going to put that into our system, including the new customer. So the new customer is going to be string music. And that's going to be the customer name. So I'm going to copy that. And we're going to put that down here. I'll put that in the name field as well. I'm going to put the... that's all I'm going to put here. I'm not going to add all the contact information, but just note that in practice, it just depends on how many customers you have. If you have a lot of small customers, you don't have a lot of repeat business, then it may not be as useful to have all the other data. But if you have a small amount of customers that are large, then of course you want as much contact information as you can have so you can send out your newsletter and all that kind of stuff. So I'm going to then say save. So there's our new customer set up. Close this back out. Then I'm going to put in here string music. String music. So there's our new customer. So I'm just going to put a reference number here, receipt number. And then I'm going to say the date is going to be 011420. And then the amount we're going to have will be populated as we enter the data down below. Now note what I'm not going to do, because when we enter the string music, it didn't pop back over here to the invoice tab because there are no invoices related to string music. If there were, we'd still kind of go over here. We'd still want to jump over here to the apply to revenues tab because we're basically making a sales receipt. So same kind of form, but we're in a different tab now. So I'm going to then populate this in a similar way as we would with an invoice. We're going to say this is going to be a quantity 1. They bought an Epiphone semi-hollow body, which is an ESH, I believe. ESH. Yep, that's the Epiphone semi-hollow body. It's going to be $400. And there will be tax applied to it. So I'm going to go ahead and apply the tax down here. I'm going to say there's going to be tax. So there's going to be the tax calculation. So we have that. So what's the effect of this transaction going to be? And notice it's going into the cash on hand account rather than the checking account, because we're going to put it through that clearing account too. And also note that this could be something that you get cash, just cash for instead of a check, which makes it more difficult to kind of deposit as you go. You can imagine cash in the cash register, which we're going to have to go to the bank to cash and put it all in basically one lump sum, even though we got it from multiple different customers, which drives a further need for us to basically have that clearing account. All right, so what's this going to do when we record it? Well, it's going to be a sales receipt now. We're not receiving payment on an invoice, and therefore what's going to happen is the cash on hand is going to go up. So the cash is going to go up. It's going to go up by the full amount, the 400 plus the sales tax of the 38, the 438. And then the other side is going to go to the income statement, but the income statement's only going to go up by the 400, the sales amount. The difference is the 38 for the sales tax. It's going to go into the sales tax payable. And then the inventory also going down, not by any amount on this actual form, but being driven, like with the invoice, by the inventory item. So the inventory item knows what the cost is using a first in, first out method, which is what we have chosen. It'll be decreasing inventory by it. Other side then going to the cost of goods sold related to the other side of the inventory going down. Cost of goods sold expense account, increasing the expense account, decreasing then the net income for it. Let's check it out then. Let's save it and then go to our financials. So I'm going to save that and take a look at that on our financials. So now we're going to do like the audit type thing. We're going to go to the end document, the financial statements, and then take it back to the source document, the sales receipt. So we're going to go to the balance sheet. So within the balance sheet, if we go into the cash on hand, double clicking on that cash on hand, we have the string music. So if I double click on the string music, there is our information. There's the total amount of the 438. Closing this back out, closing this back out. The other side on the income statement. So if we then take a look at the income statement and refresh it, if it's not refreshed for you, then we're going to go to the sales income. In the sales income, there's the 400. Only the 400 doesn't include the sales tax this time in, of course, our sales receipt. Closing this back out. Also note, if you take a look at the activity, we had basically 2 invoices that recorded this information and then the sales receipts in our sales. So in other words, this item is going to be a invoice, right? And this is going to be a sales receipt. Those are the 2 kind of forms that will typically be increasing the income account of the sales account. Closing this back out, we're going to go back to the balance sheet. So we'll go on back to the balance sheet over here. And then we have the sales tax payable. So there's the sales tax payable. I won't go into it, but that's going to be the difference. We also know that inventory is going to be going down. So inventory went down because we sold a guitar, and that's what we do, like we sell guitars. So that's our inventory. So I'm going to double click on the inventory. and it's going to go down by 320. Now that 320 is actually not on the sales receipt at all, but it's being driven by the sales receipt. The sales receipt knows what that 320 should be given the item. The item is what's helping us out to decrease that by the 320. Closing this back out, closing this back out. The other side of that is going to be going to the income statement, P&L, profit and loss. So if I go back on over to the income statement, that's going to be in the cost of goods sold. So if we go into the cost of goods sold, we'll see that 320, once again, increasing that expense account, decreasing net income. What's the effect on the income statement? Well, the increase in the sales minus the increase in the cost of goods sold will be the net effect on the income statement. So that's going to be it for now. Let's get out of here.